Hey, it's Matthew. I want to talk about automobile leasing or versus buying. That's probably a decision you've had to make for your business or your personal life. And I find a lot of the resources on the internet, they discuss all the factors, but it's often kind of vague in terms of what do I really need to know to just make the right decision for me and personally or me or my business. And so I want to share some of my observations as I have both purchase cars and lease cars, although the last many years I've been leasing them, and I want to explain why in case it might work for you as well. So let's start with the key decisions and key benefits and drawbacks. So first is that a lease versus buy will result in a lower monthly or bi-weekly payment for the automobile that you choose. And here's the reason why that is. When you're buying something, let's say it's a $30,000 automobile, you have to finance the entire value of that car. So if it's $30,000, you're financing $30,000. And by financing, I mean whether you're paying cash or getting a loan or whatever it may be, you're still paying the full $30,000 for that car. With a lease, you're only paying for the value of the car while you drive it, or the depreciated value of your car while you drive it. For example, if the car is $30,000 and you're going to lease the car for 3 years, you're basically renting the car. I know that people don't like to use that word sometimes for leasing, but that's really what it is. You're renting the car for 3 years. Could be 2 years, could be 4 years based on your lease, but let's say it's 3 years. So if the value of the car is $30,000 today, that's the selling price. And what the leasing company does is it figures out what's the value of the car when you return it 3 years later. That's called the residual value. So the current value, $30,000, what's the residual value? Most cars you might find that after 3 years they're going to be about half their original value. So purchase price, original value, current value $30,000, residual value after 3 years maybe $15,000. That means the car, through normal driving practices, normal wear and tear, has depreciated, has lost $15,000 in value. So what you're financing is that $15,000 of loss in value. So 30,000 down to 15, that's the value in 3 years. You're financing the 15. So you can see here you're financing 15,000 instead of the full 30,000. So your payments end up being much lower. That allows you to do a couple things. Number one, you could actually buy a better car, a more expensive car for a lower monthly bi-weekly price. You can also preserve cash. So early on in my business where I really needed to preserve cash for both business and life purposes, I needed a low payment, and I didn't want to do something crazy like a 9-year car payment, but so a lease ended up being a better value for me at the time. Now, a couple things you have to consider with the residual value is that value set by the financing company based on how many miles they expect you to operate the car, how many years, and so on. And different companies will set a different residual value, and also based on the model of the car. So some higher end cars may retain their value longer than less expensive cars, which means in some cases you may actually get a better car at a better value simply because the car maintains its value for a longer period of time. But that again, I mean, instead of going from 30,000 down to 15,000 after 3 years, it might go from 30,000 to 17,000. Which means you're not financing 15,000, you're only financing 13,000. So some cars maintain a stronger residual value, which means you're financing less and gives you more value as the lease owner. So, which also means on the flip side, you have to be careful with the residual value because some companies might try to, I won't say trick you, but a lot of people don't look at these details and they might set a lower residual value than they really should. Wait a minute. This car should be valued at $15,000 after 3 years, and you're only valuing it at $13,000. That means you're forcing me to pay an extra couple $1,000s. I don't like that deal. So you really have to look at that residual value and check various sites and so on to see if that value being given by the financing company is a reasonable value. All right. So if you run a business and you lease a car, you can, in some jurisdictions, you can claim that lease expense, that monthly payment as an expense in your business, which will reduce your tax liability, so that could be a benefit. If you use your automobile for business, it's very important. You can't do this with a personal automobile. It has to be something used for business, and there's a percentage of how much you use it for business, so you really have to consult your tax advisors based on your jurisdiction to see if that's a benefit for you. The other reason that I often lease is because of warranty. So if I lease a car for 3 years, generally most cars are under warranty for at least 3 years, which means I don't have to worry about anything. And I've got enough worries in my running my businesses that I don't have to worry about my car, right? If something happens to the car, don't care, it's under warranty. Somebody else will figure out what to fix and how much it costs. Whereas if I purchased the car and it had some type of issue, maybe you have to consider the expense that goes. And now, of course, even new cars have warranties as well. But maybe if you're buying a used car, you may not have that warranty, and all of a sudden, a maintenance of $1,000 or $2,000 could be problematic in your life or business. And so I know myself, particularly early on in my businesses, I didn't want that risk or that distraction of something related to my car. So that's why I chose to lease. The other thing you can do too is every time your lease is up after 3 years or 4 years or whatever you lease it to, you can then get another car, a new car, perhaps even at the same payment as well. And some people find that to be a benefit. One thing you do have to consider when you're leasing cars is mileage. So the residual value of the car is determined based on how many miles you might drive. So the more you drive a car, the more wear and tear you're putting on that car, which means it reduces its value over time, right? So leasing companies will say, we'll lease the car for you for 3 years. Here's the residual value after 3 years, but you can only drive it for 20,000 kilometers per year or 15,000 miles. Generally, they'll say per year, but it's usually for the entire lease agreement. So if it's a 3-year lease at 20,000 per year, that's 60,000. So when you return the car after those 3 years, they're going to check the odometer to see if you've gone over that 60,000, and if you've gone over, you actually pay additional fees per mile or kilometer that you've gone over that number. So you do have to be careful with that. So if you're somebody that actually drives a lot of miles, then leasing is probably not going to be a great fit for you, because you'll end up paying too much for these additional fees. So that's often a deal breaker. If you drive a lot, a lease is usually just not going to work for you. Another benefit of a lease for me personally was I don't have to deal with what happens after the lease is done. I don't have to worry about selling the car myself, posting it on some website and having people come and see the car, negotiating prices. Don't have to deal with that. I don't have to deal with going to the dealership to trade in the car and worrying about what value they're giving me on the car. I don't have to worry about any of that. With a lease, after a certain amount of time, you return the car and you're good. Now, you do have to be careful. There's another important thing you have to worry about in your lease that people often forget, and that is you have to return the car in good condition, right? So even though they're expecting the car to depreciate and they expect there's going to be some wear and tear, each leasing company will have different conditions on what wear and tear means. And so, if you ding the tire wheels, which probably happens a lot, or if you got a chip in the windshield or a scratch on the door or the hood, some of it may be considered normal wear and tear and you don't have to pay extra. Others they may charge you for, and those charges could add up quite a bit. So that is one of the worries you have when you're driving a leased car is, any little dings and scratches that you may not care that much about if it's your car, because you're not planning on selling it right away, then that could really hurt the numbers financially. So you do have to be careful. There is some actually additional insurance you can buy to cover those extra dings and unexpected maintenance, but again, it may or may not make sense for you. If you're buying a car and you're fully paying the entire cost of that car, and it's a brand new car, I find if you do the math that generally if you're going to own the car for more than 5 years, more likely 6 years, 7 years and up, you're going to get a better value by buying the car. Now, of course, there's always the risk of maintenance. If there's big maintenance that happens and you didn't expect it, you absolutely could be in trouble. For example, if you do lease one car for 3 years and it's totally under warranty, you don't have to worry about maintenance. And then you return that car and lease another car for another 3 years. That's a brand new car under warranty again. You don't have to worry about maintenance. So that's 6 years of driving that you didn't have to worry about maintenance because it was all covered under warranty. You drove 2 new cars. If you bought a car instead and held it for 6 years, well, within 3 years, 4 years, 5 years, you're going to be out of warranty, and there could be a significant maintenance issue that could arise, or nothing could happen and you're luck out, right? But these are things you can't really predict. But what's important to know is from a math perspective, if you don't have any significant maintenance issues, once you own a car for 5 years, usually 6, 7 and up, you're now benefiting financially by not leasing, because leasing would have cost you a lot more. Now, of course, again, you now have a 5, 6, 7-year-old car that you're driving as opposed to a newer car, and if you're okay with that, you're making money, you're doing well financially. So the last thing I'll explore a little bit further is this idea of renting or leasing versus owning. And you know, with cars, again, it's always called leasing, but really it's fundamentally it's renting. And I don't think that word is used because people see renting as negative a lot of ways, because you feel like you're giving your money, you're not building any equity. And you often hear this with home ownership, right? You know, people who are renting an apartment or a home, and then they feel like, oh, I'm not building any equity, and I really need to own my own property to build equity. Well, that's kind of complicated, and people confuse some of this stuff. So the couple things to consider when you're renting versus owning. So if you're renting your apartment or your home, you don't have to worry about maintenance. You don't have to worry about property taxes. You don't have to worry about insurance on the building. You don't have to worry about the value of real estate going up and down. So it really takes a lot off of your mind just to be able to pay rent and not worry about the rest of the things. Others will say, yeah, but you're not building equity. Well, yes, you're not building equity, but you know, you have to consider all these other expenses that you're not incurring as well. Plus, you have to consider if it's property or real estate, is the value really going to go up? And it doesn't always go up. We always hear the great stories of real estate going up and skyrocketing, but in a lot of places it doesn't go up. In some cases it goes down, right, based on whatever is happening either very regionally or globally as well. And so renting and leasing a car is very similar in the sense that you know, there's a lot of things you don't have to worry about. But here's the big difference between a car and real estate, is a car is almost always going to depreciate in value. The value of a car is always going to go down. You know, there may be an extremely rare circumstance of a very expensive and unique car that may appreciate over time, but generally your average car is always going to depreciate, and it depreciates very, very quickly, right? Within 3 years, most cars are losing half of their value. So you have to consider, well, are you really buying an asset when if that asset is actually continually to depreciate, and eventually it'll go down to zero. You know, when that car stops running or has any issues, it's eventually going to go down to zero relatively quickly. So yes, you are buying into equity to some extent, especially if you're going to hold that car 5, 6, 7 years and it's going to operate okay. But in the big scheme of things, it's not really building equity the way a lot of people think they're building equity, because of the fact that it's a depreciating asset. Anyway, I hope this information might be helpful to you in trying to determine whether you should buy or lease your next automobile. Matthew Giorgio.